Okay, let's just dive right in. If you're paying any attention to the crypto markets right now, you've seen it. It's been a bloodbath, fast, brutal, and it's left a ton of people wondering what is going on.
Just look at this number. In the last week alone, over $200 billion have just been erased from the total crypto market cap. That's not a dip, that's a crater.
And you can feel it, right? It's not just about the money, it's the mood. The fear and greed index, it's tanked to 15. We're not talking about just fear here. This is extreme fear. Bitcoin has broken through some really critical support levels, and things are tense, to say the least.
But here's the thing, and this is so important to get. This is not just normal volatility. This isn't just crypto being crypto. No, this crash is not random. It's actually the result of three powerful forces all converging at the exact same time.
So let's break down exactly what those three forces are. First, there's a global money squeeze happening. Second, we've got this internal crypto domino effect. And third, something I like to call regulatory exhaustion. If you can understand these three things, you'll understand exactly what's happening to the market.
All right, let's get into reason number one. This is the big one. It's the macroeconomic pressure cooker that's been building up for a while now.
It all comes down to the cold, hard reality of monetary policy. Central banks, especially the Federal Reserve, have basically said, nope, no early rate cuts for you. This keeps the cost of money high, and it's a process called quantitative tightening, or QT. You can think of it like this. Cheap money is the lifeblood for risky assets like crypto, and QT is literally cutting off the supply.
And this right here shows you the result. I mean, put yourself in the shoes of a big fund manager. Why on earth would you gamble on a super volatile asset when you can get a guaranteed 5% return from a government bond with almost zero risk? It's a no-brainer. This creates what we call a risk-off environment where big investors dump their riskiest stuff first. And guess what's at the top of that list? Yep, crypto.
But it's not all about the Fed and the big picture. That's only half the story. The second force is a weakness that's built right into the crypto market's DNA. It's an internal problem. Get this. In one single 24-hour period recently, $19 billion in leveraged long positions were just wiped out. Forcibly liquidated, $19 billion. That's just a colossal deleveraging event, and it shows you just how shaky the foundation can be.
So how does something like this even happen? Well, it's a domino effect. We call it a liquidation cascade. It starts with one trader using a ton of leverage. Then the price dips just a little bit, but it's enough to trigger an automatic liquidation. The exchange has to forcibly sell their assets to cover the loan. Well, that forced selling pushes the price down even more, which, you guessed it, triggers the next person's liquidation. It's this nasty, vicious downward spiral.
And here's the kicker. This kind of price action has nothing to do with fundamentals. It's not driven by people suddenly thinking a project is worthless. It's driven by a programmed mechanical process. It's an automated purge of over-leveraged positions. And that makes the market super vulnerable to manipulation, because big players can intentionally push prices down just enough to start that cascade.
Okay, so our third and final force is less about algorithms and more about psychology. It's a simple idea. Uncertainty is a huge liability.
Just take a look at the EU's new MiCA regulation. Now, long-term, it might bring clarity, but right now, it's a nightmare to implement. We're talking new licenses, crazy strict consumer protection rules, beefed up anti-money laundering frameworks, and huge capital requirements. For a lot of crypto projects and exchanges, the paperwork and the cost are just suffocating.
So with all this regulatory chaos, what do you think the big money is doing? The institutional investors? They're doing nothing. They are sitting on the sidelines, waiting for all this regulatory dust to settle before they even think about deploying serious capital. And that hesitation, that lack of big buyers, just sucks a massive amount of support out of the market.
Okay, so you have these three massive forces all hitting the market at once. It's totally understandable to feel some panic, but a professional doesn't panic. A professional sees this as a time for smart portfolio management.
Look, from a professional's perspective, this is actually a necessary stress test for the market. It's painful, for sure, but it's also essential. It's flushing out all the crazy speculation and the completely distorted valuations that got built up. Think of it as a much-needed market correction.
So, how does a professional respond? It's not complicated. It really rests on three solid pillars. First, reevaluating your own risk tolerance. Second, focusing on actual fundamental value. And third, making sure you are properly hedged and diversified.
Let's start with Pillar 1.
You got to be honest with yourself. If this crash is keeping you up at night, it's a simple sign. Your risk exposure is too high, period. In a market like this, where leverage can destroy you, your number one priority isn't buying the dip. It's deleveraging. It's reducing your risk, not trying to catch a falling knife.
Number 2, ignore all the noise and focus on what's real, the utility. Now is the time to be a detective. Analyze a project's tokenomics, look at its cash flow, find out how many active users it actually has. In a bull market, nobody cares about this stuff. It's all hype. But in a crash, fundamentals are the only things that matter. The goal here is to buy real value, not just a ticker symbol that's gone down a lot.
And finally, Pillar 3, hedge and diversify. If this crash has taught us anything, it's that crypto is not in its own little world. It is highly correlated with tech stocks and other global risk assets. So to build a truly resilient portfolio, you need things that don't move in lockstep with crypto. That could mean holding more cash, buying some short-term bonds, anything that zig when crypto zags.
So I'll leave you with this final question to think about. Take a hard look at your own holdings and ask yourself, is my portfolio built to withstand this kind of stress, or was it only built for speculation in a bull market? Your honest answer to that question will tell you everything you need to know about what to do next. Stay smart out there.